Thanks for joining us. First chart you've got for us is based on 52-week highs and some positive signs from that.
Yeah, I think one of the important characteristics of a durable advance is participation broadening out. And this is probably the third or fourth time over the last 18 months we've been in this 2850, 2900 range. But I think there's two differences right now. Number one, that 52-week high data is starting to expand here, so more stocks are participating in this rally. And secondly, very quietly, money growth is starting to reaccelerate. So I think liquidity here is getting a little bit better. Listen, I know seasonality is not great here over the next number of weeks, but I think ultimately you don't want to get too bearish or too defensive here.
Looking at the yield picture, what's that telling you?
Well, I find it curious that despite a PMI miss and a payroll miss last week, you already have yields back above where they were at the start of last week. That 210, 215 range I think is important. I suspect yields will stabilize here. The 10-year yield is 3 standard deviations below trend right now. It's very oversold. I would at least expect some type of a bounce here.
We saw that playing out yesterday, sure. And financials did well on it. Emerging markets, what are you looking at there?
I find it curious. You know, all the attention is on U.S. and China, but Brazil's at a new high, India at a new high, Russia at a new high, Aussie stocks act great. So when you move away from just the China story, there's actually some really good things playing out in EM. And I think specifically, emerging market credit has actually held up really well here. Typically, we think of big problems in equities, typically led lower by debt. That really hasn't been the case here the last 4, 5, 6 weeks. We think that's a positive for the EM space going forward.
And S&P closed yesterday at 2886. Everyone's talking about the 2900 level again. Yeah. What are the key levels for you?
Yeah, listen, I think when you look at the old highs at that 29.25 neighborhood, certainly important. I don't suspect we'll break out anytime soon, but I think as we start to move towards the back half of the year, it would not surprise us to see new S&P highs. I think it's important, unlike 2018, there's a lot of the world that's actually getting better here. Economic surprises bottomed. We have yields we think starting to bottom. Semiconductors look oversold enough to rally. I think those are the cyclical components we want leading this market into the back half of the year.